Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley about his chart picks of this week. Bill, what's it been like, the general trading environment for you? Because we've just finished a week where the FTSE's down around about, what, is it 12%?
Awful.
And it's not much better anywhere else in the world, but there have been sort of pools of performance, if you like, on the upside. How have you found it?
Tricky, but then focused on companies which have provided good news, good trading news, and in the right sectors, namely oil, gas, and mining.
Okay, well,
those are the areas. Yeah.
We'll come to those in a second. Let's have a look first at the sort of broad picture FTSE 350 chart that you have there for us today. If the FTSE 100 looks bad, the FTSE 350 looks even worse, doesn't it?
It does, yes. The 250 is having a rough spell, and this is what added to the 100 to make the 350. It does look bad. It's heading towards the lows again. But what I've done here, Giles, is put vertical lines on here, and these vertical lines are actually derived from where we have crossovers of the new high to low ratio at about the 80 level. So these are points where you'd actually think about going short on the market using that sort of breadth indicator. And you can see it's not been too bad from November, December, and early 2008, and we had one recently, unfortunately. This is probably why, we can actually explain why the market's going wrong. The breadth is going wrong on the new high-low ratio. So if you'd gone short at each of those points, it would have been, you'd have made something overall, wouldn't you? There.
Yes, I think you would. Yes.
Mm-hmm.
So
Yeah.
What are you expecting? You sort of reaching those bottoms again, testing that bottom. What is it, about 2,800 and something, nearly 2,900? What would you like to see? I mean, or don't you care?
I don't care really. To say what I think we're going to see is we go down to the fourth window from the top, which is the number of shares above the 50, number above the 200. I think we're going to get down to an oversold zone like we did with the black line when it came down towards that level in the 2008 early period of. I think we're going to sort of have one of those big volatility sell-off days, and then we're going to bounce. So I'm expecting that in the next week or so, when there's sort of there might be a sell-off and then a rally, but that's what I expect to see. But we don't know what generally, but the back line is going to come back. Namely, the number of shares above the 200-day moving average, the percentage that are above that has got to drop back a bit further for us to reach oversold. Otherwise, we're going to languish around these levels until we don't. So and beforehand we've had rallies, and the rallies have been not broad breadth. We only had, the financials haven't been joining in, or the house builders, or the retail sector. That's been completely mashed, and with that only the mining stocks and the oil stocks taking the things higher really.
And if it wasn't for those sectors, the FTSE 100 and I guess the 250 as well would be in a lot worse shape.
Absolutely right. Yes, we're seeing actually more entrants in the 100 recently. We've got Petrofac now in the 100, which is from the oil services sector, and we have AMEC in there. So that sector is actually the strength is coming through. So that's encouraging to see that coming along. So
sign of the times with Alliance and Leicester falling out as well, isn't it? I suppose.
Absolutely right. Yes, I mean rightly so. It's the largest companies that are doing well will move higher. Yeah.
So does that then sort of put forward an argument for a tracker fund?
Absolutely right. Absolutely right. So long as this is the idea of going on to the next chart we'll look at later is KOL, which is which actually is a tracker fund of the coal miners in America.
Okay, well, you mentioned it. Let's talk about that one now.
Yeah.
Let's get that chart up. KOL, we're looking at it now.
Yeah.
What do you like about this?
Well, what I don't like about it is we haven't got much data. What I do like about it is its trend. It's fantastic. Considering sort of the markets are dropping back quite sharply across the board, this is doing very well. I've been a fan of coal for a while and still am. While energy prices are high, coal is going to be a number one winner as long as we have growth around the world. So long as there is a demand for coal sector is going to go. And yes, it might be slightly overbought recently, but the trend is upwards and onwards. So this is pretty good. The prices haven't risen as sharply as that of oil, and there's plenty of coal in America. And this is, as I say, this is part of the American scene, which I'm looking at now, the ETFs, which track long and short funds, and this particular is a long fund on tracking the subsector of the coal industry. So it's really, really good. And you mentioned earlier the tracking an index or tracking a fund is interesting as long as it's going the right way for you. and this one is.
Yeah, and that's an incredible performance when you look at that time frame. I mean, you look at that graph and the numbers on the right, and you expect it to be over, a year or two, and then you see it's actually a few months, and it's more than doubled, which is incredible.
That's right, 50% up, isn't it? Yeah.
Absolutely. Okay, fabulous. Let's have a look at the next one you want to move on to, which is ROS. What's that? Ramco
Oil. We like looking at smaller shares, Giles, don't we, occasionally, to show that we can make money.
Precisely, yeah.
But what I've done here is I've put on here a template with the big spikes on the chart here, suggest possible entry points. Now, if you marry that up with the lower levels, where the volume goes in, you'll get an entry point last week at about 43 pence, and it's up 10% today. So it's nudging towards 70 odd today. And that's in a week. So in a sort of week and 10 days, 6 days, I think, 6 trading days. So we're looking at a reasonable return if one had bought that share. And the idea behind this is buying a new high in a good sector with high volume, and this is the result of that. Followed through volume, as we can see at the bottom, and it's a winner.
Now the oil price is grabbing headlines all around the world. Does that put you off that the oil price is such a watched and talked about number that could be supporting all of these oil sector companies?
Well, it is, and I think the trend, as much as it might be, I suppose, too high, relatively so, to what may be going on, is that the trend is still up. And yet the oil companies will be supported by this, and there'll be some overbought and oversold situations. But if the trend is up, then this is the most important thing. And even if oil price does come back, where's it going to come back to? And I think we'll look at the oil price next week, if you like, where the support levels are. I think we've already spoken about the 120 level, but each position has its own support and stop losses. So whatever, Giles, if it comes back, we sell it. If it goes up, we buy it. So actually, it's very unemotional. The only thing here is making money, and if the thing doesn't go up, we get out. So and there's no pride. We talked about earlier about ego and things here. The only ego I have is where to make money next, and that's all I want to do. I'm not really sort of saying, oh, Bill got this one wrong, this one right, whatever. It's where to make money next, and that's all I'm looking for.
Bill, as always, a pleasure talking to you, and always learn a lot from our chats. Thank you very much for joining us on financialradio.co.uk. We will chat again next week.
Thanks, Charles.
Chart of the Week with Redmayne Bentley.